current U.S. administration is attempting to rebalance its trade relationships with the world, and part of that strategy includes pushing for a weaker U.S. dollar. Well, our guest today says that could have a big impact on the markets and Canadian investors specifically. Joining us now to discuss, Kevin Hebner, Global Market Strategist with TD Epic. Kevin, great to have you back on the program.
Thanks, Greg.
All right, so we got a lot to dig in here. This is fascinating stuff. 4 reasons why you're expecting a lower dollar.
So ultimately, Trump does want to rebalance the U.S. economy. Trade deficit's too big, wants to reindustrialize the economy, and he wants to reduce choke points, critical earth minerals, semiconductors, and so on. So part of this is focused on tariffs, trade deals, encouraging foreign companies to invest in the U.S. The next big part is the U.S. dollar. And the U.S. cannot rebalance the economy, cannot re-industrialize, can't reduce the trade deficit with the U.S. dollar at these levels. So the first reason to think of weaker dollars, the dollar is too expensive by about 15%. Secondly, the imbalances are just too big. The current account deficit is about $1 trillion per year. That's not sustainable. The inflows into the U.S. from foreign investors have been too strong, partly because of a belief in U.S. exceptionalism and AI. And the fourth thing is the new one. It's the Trump administration's approach to its foreign trading partners, to the currency. And we think that they do want a U.S. dollar to be weaker and are going to be implementing a host of policies to encourage that going forward.
All fascinating points. When you think about the inflows, because of the excitement over AI, and America sort of leading that space, and that being contrary to sort of some of the aims of a weaker dollar, I start thinking about the S&P 500, which has been lifted by the AI trade. How does it start to play through to the markets if they do get a weaker currency?
Yes. So the chart that we have here does show foreign ownership of U.S. equities, and you can see that it's gone up about 4x over the last 12 to 13 years. So a lot of money coming in. So if we do get a weaker U.S. dollar, that does amount to effectively an easing of financial conditions. So that's good news for a lot of investors. And I think ultimately that isn't an issue for an AI trade, because ultimately weaker financial conditions, more money to risk assets, and certainly AI is part of that. So I don't think it's necessarily bad news for the bond markets or AI, but the U.S. dollar will have to weaken a lot. And as you're mentioning earlier, important implications for Canadian investors that have a lot of their assets in U.S. dollar investments.
What does that start to look like then for Canadian investors?
So for more than a decade, the U.S. dollar has been appreciating. And so if you're a Canadian investor putting money into Meg 7 or US Tech or any other US dollar-based investor, the best strategy was not to hedge, at least ex post, not to hedge, because then you had the kicker of your investment plus the currency. Going forward, we think investors have a lot of FX risk. They're not going to be rewarded for that FX risk. So it makes sense for them to think about how to hedge their exposure in some type of sensible way. The right way to do it varies a lot investor to investor, depending upon their overall portfolio and circumstances. But whereas the best approach the last 10 years has been not to think about it, let the currency run, I think going forward, we're in a very different regime.
Canadians have been accused in the past of being a little too Canadian-centric and investing at home and not looking abroad. Is this going to sort of have us thinking of that mentality again, where you're talking about smart hedging strategies to still take part in the American economy, the American markets, but Canadians might fall back on that old kind of Canadianism, well, I'll just invest in Canadian companies at home?
Well, I think everywhere there's a local market bias. So Canada and America, Europe, that's always the case. But if you want exposure in your portfolio, for example, to tech, there's really only 2 places in the world where you can get exposure to advances in tech and AI, and that's the United States and to a lesser extent in China. So you do have to look south of the border, and it's just not just equities and tech, but other asset classes where people are putting money. So it might be that with a weaker dollar, you'll have less exposure to US dollar assets from Canadian investors, but it's still going to be quite significant.
Okay, we have another picture here we can show the audience. The cost for Canadian-based investors to hedge various currencies. What is this telling us?
Yeah, so right now the cost to hedge the US dollar for Canadian-based investors is about 2% per year. That's likely to come down to about 75 basis points per year over the next few months as the Fed starts their cutting cycle, whereas the Bank of Canada is pretty close to finish theirs. So if you think about 75 basis points per year to hedge, we think that the US dollar is going to depreciate by 15 to 20%, say, over the next 3 to 5 years. So I think the cost of hedging is going to make sense and be more than compensated for by the decline in the US dollar relative to the CAD.
These sounds like longer-term plays, too. I mean, the wheels are in motion to try to weaken the U.S. dollar. There's aims of this administration.
Yeah.
We look into the coming years as investors, whether Canadian investors, global investors. How does the world start to reshape, and what does it mean for investors?
Yeah, so the dollar did weaken a lot in H1 of this year, and the real catalyst for that was the policies of Trump towards tariffs and rethinking about U.S. exceptionalism, which still exists in tech, but maybe not a whole lot outside of tech. Going forward, we think the catalyst for the next down leg in the dollar will be the loss of Fed independence. And yesterday, Trump said that he'd like to fire one of the Fed board governors, Lisa Cook, and there will be a process for that. She needs to be charged, convicted, and we have to go through appeals and denial. So it's a reasonably long process. But Trump believes in an all-of-government approach to economic policy. So he doesn't want the Fed doing something different or opposing the direction of his policies. Ultimately, he's very persuasive. He gets things done. There isn't a lot of pushback, and there's not much pushback from markets this morning. So our feeling is he will be successful in dramatically reducing Fed independence, which means much lower interest rates, and also the Fed cooperating with the Treasury and other parts of the U.S. government in their policies to rebalance the economy. Ultimately, this means, I think, will be the catalyst for the next leg lower in the US dollar. So maybe not in the next week or two, but certainly in the next 1 to 3 quarters.
I'm a little bit surprised that the markets haven't had more of a reaction to the, as you say, it looks like a loss of Fed independence going forward. It used to be one of those things where you say, well, this must be the thing for the markets to function properly. If we're living in that kind of different world, how does that all compute?
Yeah, so where are the bond vigilantes? And basically, equity markets are doing nothing, bond markets are doing nothing. The US dollar is about 30 basis points lower today. And the easiest place to take a bet against sort of US exceptionalism, Fed independence, is on the currency. So we think that's important. But the process with Lisa Cook is just one step in many. Prediction markets are saying 30% likely that should be off the Fed board by the end of the year. So it's only 30%. It's not a certainty because there is this legal process that we need to go through. But Trump is determined, and there are a couple very important reasons why he would like to have among the 7 board governors, 4 or 5 of those being people who have an affinity to his policies.